will naturally open doors for answers in other areas as well. So I think we need to give room to the possibility of interconnectedness as well. I think in the current uncertain environment, we have the So in the current uncertain environment that we face, I deliberately choose to focus on the near term because we are very concerned about the near term uncertainties because of the tariff situation. And then later on I will also share with you some of the medium term challenges which we need to work on. One thing I want you to keep in mind is the perspective that a country that is currently having a per capita income of $2,600 but aspiring to become a country with a per capita income of close to $20,000 or $25,000, etc., and a country of this size, diversity, etc., will always have a set of challenges and issues to be dealt with. And it is very important for us not to lose perspective because the journey which we have come through so far in the last 80 years or 78 years since independence has been no less commendable, and that should give us hope about the challenges that we are going to face. Of course, context keeps changing. The world is always, in fact, when they say, there is a story that the river is the same. If you go to bathe in the river yesterday, and the same person goes to bathe in the river, they say the same person goes to the river to bathe the same river. It's not true. From one day to the other, the person is not the same and the river is not the same. So even though it may appear to be the same, things are never constant, they keep constantly shifting. So in that sense, the environment in which we traverse the last 30 years will not be the same as the next 30 years. Arguably, they are even more challenging. So I'll quickly run through, I will not walk through all the slides. I want to give some time for you to ask some questions. So not all the slides that I'm carrying with me I'll be able to show, but we'd like to focus on the medium term challenges as well. Very quickly, so the current growth rate is very good, 7.8%, first quarter this year, much higher than expected. And it is not just a story of deflator, it is a story of economic activity. And first 2 months of the current quarter also are shaping up very well. And in fact, we may be close to achieving a 7% year-on-year growth in real terms in the second quarter as well. So far, so good. In fact, the growth rates we have achieved in the last 4 years since COVID ended give rise to the possibility that we may have reached a higher level of growth than we anticipated once COVID ended, because the lagged effects of all the important structural changes that happened in the economy in the last 11 years are probably beginning to pay off in terms of a much better growth inflation trade-off than we may have anticipated. And we are doing better than other countries, not just in the immediate first quarter, but over post-COVID recovery. If you look at what's happening in the immediate neighborhood or in the Western countries today, when, for example, there have been multiple changes of government in several countries, prime ministers, etc. I think we have had both economic and political stability in the last several years, combined with fiscal stability, and all of that is giving us a good foundation and platform to continue on the growth path, especially if the current trade-related uncertainties get resolved reasonably quickly, as I expect them to. Then I think we will have the growth momentum to support even more reforms that we need to undertake, not just at the union government level, but more importantly, in fact, at the state government level. This is a simple chart of the where the growth is coming from. In the first quarter, we had manufacturing and services contributing to growth. Agriculture naturally in the summer months is a bit slow, but it should it should continue to grow more than it did in the first quarter in the coming quarters. Our distribution of growth is very interesting and very reassuring. 60% comes from consumption, 30% comes from capital formation, 21% comes from exports, and 23% goes towards imports. So we have a large domestic economy which insulates us from what is going on in the outside world to some extent. That is why when we discuss the impact of tariff, while one shouldn't trivialize the impact on affected sectors, from a systemic perspective or the macro perspective, the impact is relatively marginal. That is not to say that there will not be second and third round effects if the tariff persists in terms of sentiment impact, capital formation, etc. But purely in export terms, given the fact that we are a country which relies on domestic demand, the impact will be less than it would be for countries which have a much greater share of exports in their GDP. Agriculture and rural economy both remain very bright spots. Rural wages are rising very rapidly, as you can see on the right side. The area of the cultivation has picked up. Water levels are very adequate, so we will see a much bigger contribution of agriculture to value added in the coming quarters, which will also offset to some extent the external trade related impact which will come in the coming quarters from the tariff if they persist. But as I said, I hope that they will dissipate soon. Industrial sector is doing well. We are providing you multiple indicators. I don't need to walk you through every single chart on this slide in the interest of time. They are self-explanatory. By and large, whether it is the Purchasing Managers Index, which is based on feedback from you, the e-way bill generation, the growth rates of 22% this year in the first 4 months compared to last year, overall energy consumption, they all are stable to growing moderately. Same is the case with services sector, railway free data, air and sea cargo handling, and the levels of confidence in the services sector, they all are in good shape. So in fact, I would like to point out that we in the Department of Economic Affairs, we bring out a monthly economic review around the 3rd or the 4th week of the month. I would like you to look at it. It's in the Department of Economic Affairs website, where we try to cover a lot of indicators that we follow to make sure that we are on top of how the economy is developing, so that we can flag areas of concern to policymakers as soon as we notice them. In this slide, what we are trying to show is how is the rural demand in the current year compared to the pre-COVID average and compared to last financial year, which is on the right side. On the left side, you see recent quarters or recent months, depending on data availability. In general, obviously, you're not going to remember these individual numbers. But broadly speaking, you see more green than amber or red, which is a good thing. Which means rural demand indicators are doing better than last year or the pre-COVID average, whether it is two-wheeler, three-wheeler sales, tractor sales, etc. Obviously, the story doesn't look similar if you look at urban demand, because there is more amber than green and one red as well. So that is, on the surface, there is some weakness in urban demand. Post-COVID, in 22-23 and 23-24, we thought it is going to be, we were talking more about urban demand doing better than rural demand. Now in the last 1 or 2 years, we see the opposite. But that is where I think the government's few measures taken in the last 2 budgets, whether it is the huge tax cut, GST relief, and the employment-linked incentive scheme, all these 3 developments, along with the fact that food inflation is very low, which is giving more disposable income in the hands of the households, these things are going to contribute to the pickup in urban demand, which is on the surface looking weaker. But I would also invite you to look below the surface or beneath the surface. Much of the urban consumption may also be now getting diverted or shifting towards non-listed companies or through UPI payments to even smaller enterprises which are not captured in the quarterly data coming from the Ministry of Statistics. If you look at this coming from the National Payment Corporation website, you can see that every single category, whether it is utilities, packages, candies, cigar shops, bakeries, drugstore, eating places and restaurants, the growth rate is at least 20% annualized in the last 13 months. And in many cases, the growth rate is well ahead of 30%. So in other words, we may not be measuring urban consumption as well as we would like to by relying only on the data coming from listed fast-moving consumer goods companies. Underlying urban demand will be more resilient than we think it is. And the other thing which we all are interested in is looking at how much bank credit is flowing into industry. On the surface, bank credit flow to small and medium enterprises is doing very well. Sorry, micro and small enterprises, which you see on the bottom left. Credit to industry, I think the two charts are a repeat of each other. My apologies for that. So top left and bottom right are the same data. Basically, credit to industry seems like it is growing at a rate similar to last 5 years of average. But again, there are some very interesting and important structural changes happening in the economy, which you see on the right side. Today, more and more Indian companies are able to raise funds from the capital market more than they used to do from the banks. If you look at RBI data, and I don't expect that all of you would do so, but if you look at RBI data, Handbook of Statistics, it shows funds raised by Indian industry from the banks, non-banks, capital markets, commercial paper issuance. The average growth rate in the last 6 years is 28.5% per annum, year after year after year. So in other words, growth in bank credit is not the only barometer of lending appetite or borrowing appetite or investment. Overall, resource mobilized in the economy has been growing at a very, very good rate in the last 6 years, which is also a sign of a healthy economy, by the way. Now, this is where I think all of us are worried about, and I will take some time to talk about the tariff here. Yes, not only the original reciprocal tariff of 25% plus the penal tariff of 25%, both were not anticipated. I still believe that geopolitical circumstances may have led to the second 25% tariff, but considering recent developments in the last couple of weeks and so on, I do believe, I have no particular basis to say so, it's just my intuition, that the penal tariff will not be there beyond November 30th. I mean, it's not a statement of based on any concrete indicator or evidence. It's my hope that given the recent developments which we see in terms of both countries finding an off-ramp and reaching out to each other, and including the important negotiator being in India in the first 2 days of this week, I do believe that there will be a resolution in the next couple of months on the penal tariff and hopefully on the reciprocal tariff also. So whatever impact that is there because of the affected sectors, which by the way is 45% of overall exports to the US, and in the first 5 months of the current financial year, we have already exported half the amount we exported last year to the US, etc. Keeping all those things in mind, we hope that the impact will be limited to the current financial year. Of course, if it continues into the next financial year, there will be an impact on growth, but it's hard to quantify these things because it is not just the actual export loss, which is very easy to calculate. That's a very small sum. But naturally, it will have implications for sentiment, investments, employment in those industries, and therefore consumption, etc., which is very difficult to quantify and it will be very imprecise. But nonetheless, our hope is that our exports have been growing quite well. We are between services and goods. We are now exporting close to $850 billion a year, and we are on top. We are on track to reach $1 trillion of exports, and an economy of the size of $4 trillion, that's 25% of GDP, which is a very healthy number. We are not a closed economy. We are an open economy in that sense. We may not be as open as small economies, but given that we are a large one, 25% in terms of export, and if you include imports, it is close to 48% or 50% of GDP. And even if you exclude petroleum, crude oil imports and petroleum product exports, it is close to 25% of GDP between imports and exports. So we are an open economy, and therefore what happens in the external sector will have spillover effects. And that's both good and bad. So, but even without tariffs, even without the tariffs, our export growth performance will now have to work doubly harder compared to, let's say, between 2003 and 2008, because global growth is going to be a challenge. So that is where we have to work hard in terms of innovation, in terms of reaching new geographies, in terms of investing in R&D for the long term. So the rising tide of global demand, which lifted all boats in the first decade of the new millennium, will not be there. The tide will not be rising. Therefore, we have to create the momentum for export growth. And that is where I expect the industry and chambers to work doubly harder in terms of improving our competitiveness. I just want you to think about how the Indian pharma companies dealt with the global trade-related intellectual property and services agreement, TRIPS agreement, in 1995. It appeared as if the bottom was removed from the Indian pharma exports, but almost all of them doubled or tripled their investment in R&D and recaptured the market share. So what the Indian pharma companies did in 1995 in response to the TRIPS agreement is a case study which we all need to go back and look at. And how did they do it? Most important thing I remember is the trebling of investment, doubling and trebling of investment in R&D. There is no substitute for a long horizon mindset, okay? And that is what we need to do now in the industry. That is the ask we have from the government side in response to the many asks that the President had in his opening remarks. And our external deficit, our FDI numbers, there again, I think, yes, there is much more that the policy establishment has to do, but at the gross level, our FDI numbers are quite good. And this year's run rate at $25 billion in the first quarter is looking at a run rate of $100 billion, which is a good thing. But naturally, companies have been also repatriating their invested capital in the last few years because we have a very buoyant capital market until recently. And because of that, there has been profit taking as well, which is a good thing. It is not a sign of concern. Profit taking shows that there is a profit to be made in the first place, and Indian market provides easy exit, convertibility, etc. All those things are there. They are important boxes to be ticked. So, as long as gross inflows remain high and keep moving higher, we shouldn't be overly concerned. But that said, we do want to make India part of global value chain, and therefore whatever policy can do, we will continue to examine them for improving our FDI inflows, how to plug India into global value chains. Those are areas of priority, but by and large, external parameters also are looking good, and there are enough signs that companies are looking at India very closely. These are just few of the headlines that we have seen in the last few years. Key priority areas: continuing to invest from the government side on infrastructure, incentivizing private investment, ease of doing business, systematic deregulation, continued formalization through digitization, boosting agricultural growth. These are the policy priorities. I'll just quickly talk about them. Our capital formation actually has done very well in the last 20 years or so, 25 years. In spite of the banking crisis we had, we have done as well as Vietnam has done in terms of capital formation. In constant prices and current prices, we have done reasonably well. So, India has been investing in productive capacity, and government used to spend only 3.1 lakh crores in FY19, the 1 year before COVID, and now last year 10.5 lakh crores, and that is an increase of more than 3.4 times. And this investment by the government hasn't come at the expense of the overall public sector, which also has grown from 11.1 lakh crores to 19.8 lakh crores budgeted this year. On the right side, you see, of course, the various sectors to which government investment goes, the big ones. But by and large, this commitment to public investment is one of the important contributors to the fact that we have been able to grow at a much faster rate post-COVID than anticipated. And these are all the important tangible markers or milestones or achievements in infrastructure creation. Simply want to draw your attention to the fact that the number of airports in India built in the last 11 years is more than what we built in the first 7 decades since independence. And the port handling capacity has improved tremendously, that we even do better than East Asian ports. And that's a no mean achievement to be able to do better than East Asian ports in terms of handling efficiencies or in terms of highways construction. If you look at the overall investment trends, imports of capital goods, imports of production of IIP, capital goods and infrastructure goods, etc., whether it is looking at the financial year basis or looking at the first 4 months of the financial year, I think the trends are good. Indian industry, both public and private sector, are continuing to invest along with government, especially state governments this year, are picking up on their capital investment compared to last year. Manufacturing share of GDP in constant prices is about 18%. Much of the hand-wringing we see in the media or in public commentary about manufacturing share of GDP going down is because of the failure to understand that price index keeps rising faster in agriculture because of annual guaranteed price increases. Manufacturing prices in fact don't rise that much. Manufacturing is subject to competition, subject to technological improvements, etc. So manufacturing goods prices rise much slower. This is what you see on the left side. That is why in GVA share, agricultural share keeps rising, manufacturing share appears to keep going down, and that is largely the price effect. If you remove the price effect, manufacturing share is, I'm not saying it is doing very well, but definitely it is not declining, it is constant. We need to rise manufacturing. Some of you may have picked up the copy of the book, Patrick McGee's book, Apple in China. And in that book, Patrick McGee cites a Chinese government document to say, no manufacturing, no nation. So I think it's important because manufacturing is the basis on which services sector grows. Once there is a factory in a location, you get banking, you get insurance, you get hospitals, you get schools, you get multiple services, childcare, everything springs up, or sporting outlets, social clubs. So services sector grows on the back of the manufacturing sector. India was fortunate to be able to have a service sector growth in the 1990s onwards because of software and electronics, but by and large services does very well on the back of manufacturing, other than electronic services of course. So therefore manufacturing is critical and we need to do more, but I want to get the facts right in terms of why some hand-wringing about the declining share of manufacturing in GVA is misplaced. It is driven by price indices rather than by actual decline in manufacturing. But critical to manufacturing growth is the fortunes of micro, small and medium enterprises. And we are doing quite well. In fact, this government in the last 11 years has spent so much of effort on formalizing the MSME sector. And one of the ways of formalization is, of course, the receivables, access to finance. On the right side, what I am showing to you is an important success story which you need to learn about. The receivables exchange. Some of you will be very familiar with it. From nothing almost in FY18, 2.3 lakh crores are discounted to receivables exchanges, which means SMEs get immediate money for the goods they supply to large enterprises, whether in public sector or private sector. So more state governments, more union government ministries and more private sector participants have to discount the bills in receivables exchanges. This is what will enable our MSMEs to get payments on time. And MSME cluster development programs and the PLI for white goods are seeing more MSME participants coming up. And if you remember the previous slide I showed you, credit growth to micro and small enterprises is running at more than 20%. And therefore, there is a very important movement that is happening in the formalization of the micro, small and medium enterprise sector, which is a contribution to GDP growth as well. And And we are also strengthening markets for our MSME manufacturers. New agreements with the UK, and there is a bilateral investment treaty with Israel that's concluded, and ongoing negotiations with Oman, European Union, Bahrain, etc. will open up new markets for our businesses. And that's important. Geographical diversification, product diversification both matter for export growth. And this is one area where I think governments in the country have to do on their part, which is continuing to make it easier to operate and to stay compliant. Instead of using the words ease of doing business, I feel that it is about ease of being honest. The regulatory and compliance framework across the country has made it difficult for Indian households, individuals and businesses to be honest. It's become more costlier to be honest. And therefore it is tempting to take shortcuts. And that is where deregulation, simplification, consolidation, third-party certifications, lengthening the duration of licenses, etc. All these things will make it less costly, to be honest. And honesty is the bedrock of trust between individuals and businesses, and between the private sector and the public sector. Once honesty is established, easy to be honest, trust builds up, and trust leads to scale. So, for Indian economy to scale up, one of the reasons is that sanctity of contracts is important. All these things start from making it easier to operate, making it easier to comply, making it easier to stay honest, so that the rule of law and the rule and sanctity of contracts can be accepted and honored. And that is why I think much work has to be done. We have done a lot of work in the last 11 to 12 years in terms of ease of doing business, decriminalization, but this movement has to continue both in the union government and the state government level. I'm happy to let you know that two high-level committees have been formed at the union government level on deregulation. You must be aware of it, under the former cabinet secretary, Mr. Rajiv Gauba. There is two informal groups of ministers looking at deregulation thoroughly, and there is an ongoing initiative with deregulation on state government areas. So in other words, deregulation is not about making us a free-for-all society, but it's about ensuring that it is easier for businesses to focus on their core competence, which is to run businesses, rather than using their limited bandwidth, especially for small and micro enterprises. Large ones can outsource compliance to other agencies, but it is the small ones that have a problem. Their limited bandwidth gets used up in compliance, and therefore, if we have to grow manufacturing, we have to grow SMEs. If we have to grow SMEs, the state has to make it easier for them to grow. And that is the entire raison d'etre of deregulation. Agriculture actually in India is not an industry or a sector of the past. It is still a sector of the future. It can add 0.5 to 0.7% to GDP growth. If we are able to emulate the growth rates you see in allied services on the right side, allied agricultural sector, if we can replicate them in the traditional crops, then the contribution of agriculture to GDP growth can go up by another 0.5% or 0.7%. And while our productivity growth is good, it is still trailing below the productivity growth rates in agriculture in other economies, in other countries around the world. Many steps have been announced in the last two budgets, in July 2024 and January 2025. Micro irrigation, area under micro irrigation has gone up by 3x in the last 10 years or so. But we need to do more in terms of bringing area under irrigation, and that too surface water compared to groundwater. This is where I think rejuvenation of water bodies and rainwater harvesting will play a very important role, because water is the foundation to, just as if there is no manufacturing, there is no nation, it's easy to say no water, no civilization. So ultimately, it's important for us. These are all it's very easy to focus on things like tax incentives, investment, education and skilling, etc. for growth. But most of the unsung areas or unheralded areas like water management, and I'll come to one more area, these are critical for us to grow. Because without these foundations, the edifice of strong economy and faster growth cannot be built. And education and skilling, everybody knows demographic dividend requires educated population and skilled population. In 2014, the Confederation of Indian Industry and the private sector body came up with an annual employability test. In 2014, only 33% of the college graduates who took the test passed the exam. It's called CII D-Box Employability Test. We have covered in economic survey. But 10 years later in 2024, 51.4% were able to pass the test. 18 percentage point increase in the employability test pass percentage. But still you can say 48% do not pass the test. So again, the glass is half full, but equally the glass is half empty. So skilling is an ongoing initiative. Again, there's no point in me reading out everything in this slide. It is there in front of you. What are the various initiatives we have taken in terms of skilling? The biggest success story in skilling is Odisha. I was in Tirupur 3 weeks ago speaking to apparel manufacturers, and they all said the skill levels of Odisha trained workers is much higher. Subrata Bagchi of Mine 3 was appointed as the Skill Development Authority chairperson in Odisha in 2016. He was on the job until 2023. And recently he published a book called When the Chariot Moved. It's a very interesting book. I recommend that you read it. When the Chariot Moved. And the success of that effort is evident in the fact that Odisha trained workers now command a wage premium in other parts of the country. So there is a model here for the rest of the country to emulate from Odisha on skill development. But as I said, education and skilling is something everybody talks about. But what is equally important, just as water is critical for civilization and countries to grow, demographic dividend is not realizable without mentally, physically, emotionally healthy cohort. And the combination of ultra-processed foods, screen time, social media consumption is the biggest threat to demographic dividend, not education and skilling. Eventually we will get education and skilling right. It's much easier to get them right. They are concrete steps. Both policy and private sector can work together to make that happen. Because 20 years ago we used to worry about Indian children not being enrolled in schools. Today enrollment is not an issue. Up to 12 years of schooling, enrollment has picked up tremendously. Even in tertiary education, by the turn of the millennium, 6% were in tertiary education. Now it is 28.8%. That's almost a 5-fold jump in tertiary education enrollment. So we are making progress on educational enrollment. Quality of educational outcomes is a critical factor. I agree. But these things are not discussed openly. And these are silent killers in some sense. The combination of, I think, as in the deadly troika, ultra-processed food, screen time, and social media, these three put together can deny us the demographic dividend in terms of the productivity loss, emotional loss, etc. You look at digital addiction is cause for mental stress and suicidal thoughts. Again, if you are interested in understanding how it has caused huge damage and discussed in the US, Professor Jonathan Haidt, H-A-I-D-T, Jonathan Haidt's book, The Anxious Generation, is a good read. And that is why many countries are now beginning to look at bans on social media up to age 16, Meta, Instagram, YouTube, etc. It's very important. In fact, there is a study by Sapien Labs in Kriya University down south in near Chennai. Sapien Labs says the later the child is introduced to smartphones, the higher are the chances of the child completing undergraduate education successfully. The more, the younger the age when the child is introduced to smartphones and digital consumption, the more difficult the child will find even to complete undergraduate degrees. There is empirical research on that now. Structural reforms in taxation and expenditure, they are also important component along with deregulation. Again, our tax rates are now extremely competitive globally, whether it is corporates, individuals or indirect taxes. It is the tax processes which we are also addressing, whether it is faceless assessment, whether it is the ability to change your tax returns up to 4 years, and then along with GST, while the focus is on GST rates reduction and rationalization, equally important is the simplification of registration and the creation of appellate tribunal, which is in the works, etc. Those things are important, and that is what on a daily basis, the touch points for businesses, individuals with the state, with the government, is through the tax processes. And that is will always be a constant area of improvement, and these are all the various rates that are being reduced as of Monday. And this is a very radical reform of the indirect tax system, and I think the transformative potential of it is currently not fully appreciated. That is fair enough, because we ourselves will know as data comes through in the coming months as to how much it is contributing to in terms of increased consumption. The good thing is this year some 3-4 favorable tailwinds are coming together. The direct tax reduction, the simplification of direct tax bill, low food inflation, and the indirect tax reduction are all combining to put more disposable income in the hands of the Indian households, and that should very well make up for some of the trade-related drag we may experience in the third quarter or so. This is a long-term issue, and that is where I want to leave this matter with the President raised this issue about the import and export from China, etc. Ultimately, imports and exports are made by enterprises, not by the government. And therefore, how much we reduce the dependence on one country is up to the private sector. How much are we prepared to take the long view in terms of investment in R&D and capital investment and technology is a call to be made by the industry. What is the government's contribution in this apart from deregulation? The government's contribution is to bring down the cost of capital and the tax rates, which we have done. The cost of capital of Government of India comes down when we are fiscally prudent. Now look at the Government of India's 10-year borrowing cost in 2014. The Government of India could issue a 10-year bond at a yield of 9%. Today, Government of India can issue a 10-year bond at a yield of 6.5%. That's a 250 basis point reduction, 2.5% reduction. So, and that means the interest rates in the rest of the economy also come down, because the government borrowing cost is the benchmark interest rate. So the biggest stimulus, fiscal stimulus, a government can give to its countrymen, to the society at large, to the economy, is they being fiscally prudent, not by creating fiscal handouts and incentives. Because the more fiscally prudent you are, your government's borrowing cost comes down, and that gets transmitted down to the rest of the economy through lower borrowing costs for everybody else. So, with lower borrowing costs, with reasonable tax rates, ease of doing business, it is up to the private sector to figure out how to reduce supply chain vulnerabilities by being dependent on one country. If you look at the various components that we import from China, what you see in 2023, electric machinery, nuclear reactors, boilers, machinery, mineral fuels, etc., organic chemicals, fertilizers, we depend on them for a lot of areas. And if you look at our exports to China, it's mostly primary goods and raw materials, which is somewhat similar to the kind of import-export patterns we had during colonial era. And if you look at the composition of primary goods, intermediate goods and capital goods, we import a lot more capital goods from China, which means without them, you can't create downstream production. So you are forever at their mercy. And I think this is where we need to take a long-term view of our supply chain. If a product is available elsewhere, and even if it is slightly costlier, will it not be better to diversify? We talk about now realizing the diversification from, let's say, the US market to other markets, because there is a tariff issue. Similarly, even on the import side, diversification matters. Reliance on a single source for a small price advantage doesn't take into consideration the risk of disruption in supply. So in other words, the industry has to go back to the drawing board and take a look at what are we importing, what are the alternatives, and what is the risk factor embedded there, and what is the disruption to my production if the capital good doesn't come through. We saw it in the case of magnets, and it is still the case for auto sector. So reducing supply chain dependence on one country or a few countries is a responsibility that rests entirely with the private sector. And in renewable energy, electric vehicles, if you see the flag, the red color is China. So we depend on them for cobalt, lithium, graphite, copper, everything. So I think we need to understand that there is a trade-off here. So we will not be able to become a global supply chain node without creating supply chain resilience for ourselves vis-a-vis China, for example. Nonetheless, I want to conclude with some messages of hope, because as I said earlier, we have weathered and overcome odds. Barely 30 years, 60 years ago or 70 years ago, we had a very low per capita income in dollar terms. And the dollars, now we have grown to $2,600 per capita. The journey has been largely upward sloping. The pace has accelerated since 1990s, the reforms era. Barring a minor dip during COVID time, the line is smoothly upward sloping. So that augurs well for our capabilities. And in terms of capital efficiency, you might say, Dr. Nageswaran, it's fine for you to show the chart of India's per capita dollar GDP going up from 100 to 2600. Please don't deceive me. China has grown at the same time to $12,000 per capita. And they were probably at the same level or even slightly below us. So what are you trying to show? Fair enough. That's a good question. That's a good counter question to pose. But if you look at this chart, per dollar of debt in the economy, India has generated more GDP than China has. The red line is India, the blue line is China. It is basically numerated as per capita GDP, denominated as per capita non-financial sector debt. And these are all publicly available data. You just need data on population, nominal GDP in dollars, non-financial sector debt in dollar terms available from the Bank for International Settlements. You can do the calculation yourself. And basically, our capital efficiency has been therefore good. So the bulk of the growth, and I am not realizing the enormous achievement that China has made in growing its economy from 1979 onwards. It's a credible achievement, what they have done, and where they have made themselves indispensable in several areas. But it's equally important to recognize that some of the growth has come from capital accumulation or excess debt accumulation. Both are true. And there we have done better. Therefore, we have scope to grow even more in the coming years. And that is what the International Monetary Fund said in April, that we will grow to a size of $6.8 trillion from 3.9 end of March 2025. And therefore, getting to the first 8 or $10 trillion will be relatively easier by the middle of next decade. The journey afterwards becomes that much more difficult, because we are going to try and grow ourselves to become a developed economy at a time when geopolitics is becoming more polarized, more difficult, more aggressive. And the last 60 years, post-World War, was a relatively peaceful era at the global level. Second headwind that we faced, that East Asian countries did not face. Because in recent years, it is East Asia that became first world from third world. Taiwan, Singapore, Hong Kong, Korea, following Japan, and then now China is also making a shot at it. They also did not have to worry about climate change, global warming, energy transition, clean fuels, and dependence on single country for clean energy, raw materials and inputs, etc. Those were not the factors. And then the third challenge is artificial intelligence and the need to create jobs as well at the same time. So these challenges were not big for other countries which made the transition from third world to first world, whereas we need to overcome these challenges as well. But that is what nation building is all about. And it is not going to come through only because the government will do the job. It will come through because all of us will do it together. So in the near term, I believe the tariff uncertainty will resolve itself. Even without that, our growth momentum looks good. And we have predicted a growth rate or estimated a growth of 6.3 to 6.8% this year in real terms. At the moment, we are not revising it down. If anything, we feel more confident that the growth rate will be closer to the upper end of this range for this financial year. We have a lot of things going good for us. We need to build on them. And growth takes not only government's efforts at making voluntary economic activity easier, it also requires long-term thinking on the part of the industry. Thank you very much.